Having understood the profit and loss from the perspective of financial reporting and from the perspective of decision making, let us now come to the second statement, and that is balance sheet. So, how do we decode the balance sheet? So, for decoding the balance sheet, we all understand it very well. The balance sheet is always as at a date. It is as on a date. P&L is for a period, or it can be for a year. It can be for 3 months, 6 months, 1 month, whatever, 12 months. Balance sheet is always as on a date. Now, what we need to understand, friends, as far as the balance sheet is concerned, number one, the balance sheet has got 5 components. First component is equity and liability. Equity. The second component is non-current liabilities. Third component is the current liabilities. Fourth component is the non-current assets, and the fifth component is current assets. So, as company secretaries or PCSs, we need to first understand these 5 broad terms. So once we understand these 5 broad terms, then of course we will also look at them, all the line items in the balance sheet one by one. So first of all, what we have is these 4 components put together. So your equity share capital, your preference share capital, your share premium, and reserves and surplus. So these 4 components put together, they are known as shareholders fund. It is known as shareholders fund. What does it mean? It simply means this is the money of the shareholders into the business. So this is how it is regarded, shareholders fund. Then you have something which is known as non-current liabilities and the current liabilities. So let me first tell you what is current liability. Current liability is very simple. Obligations of a business which are to be discharged by the business within a period of 12 months from the date of the balance sheet are known as current liabilities. So the liabilities of a business which the business has to discharge within a period of 12 months from the date of the balance sheet are known as current liabilities. What is a non-current liability? Friends, the definition of non-current liability is very simple. The definition of non-current liability is a liability which is not a current liability is a non-current liability. Now what does it mean? It simply means all the obligations of a business which are to be discharged by the business beyond a period of 12 months are known as non-current liabilities. So this is the difference between the current liabilities and the non-current liabilities. Then we also need to understand the difference between the current assets and the non-current assets. And this is where again, so what are the current assets? And please remember, friends, here, and this is what you must make note. Current assets can be of 2 types. Current assets can be of 2 types: non-operating current assets and the operating current assets. And that is what we need to understand. So what is the meaning of operating current assets? So those current assets which help the business in running its operations are known as operating current assets. So example, inventory, receivable, loans and advances given for the purpose of running the business, and cash and bank balance. So these are the examples of operating current assets. So what is a current asset? Current asset is one that is expected to get converted into cash, and that is your current asset, right? So inventory is an example of current asset. Now why inventory is an example of current asset? And that is because you purchase raw material. You purchase raw material not with an intent to hold it in your factory for all the times to come. You purchase the raw material because you want to take it to the shop floor, convert it into finished goods, convert it into WIP, then into finished goods, then sell it in the market. And when you sell it in the market, you get money from the customer. And so that raw material which you purchased is getting converted into cash. So current assets are the one which are expected to get converted into cash within a period of 1 year. Now what are the non-current assets? The non-current assets, remember, are the ones that give you benefit over an enduring period. Non-current assets are the ones that give you benefit over the years. So your land, building, plant and machinery, computer, furniture, and all that are example of non-current assets. And here, friends, I would like you to make a special note. What is the relationship between a current asset and the non-current asset? The relationship between the current asset and the non-current asset is very simple. Current assets are expected to get converted into cash within a period of 1 year. Non-current assets are used to convert the current assets into cash. So how do you convert the inventory into cash? You convert the inventory into cash by using your land, building, plant and machinery, by manufacturing finished goods from that raw material, and that is the relationship between the current assets and the non-current assets. And let me repeat it once again. Current assets are the one which are expected to get converted into cash within a period of 1 year. Non-current assets are the ones which give you benefit over the years and which are used for converting current assets into cash. So with this understanding, friends, of these 5 components of a balance sheet, let us now go and understand all these line items one by one so that we have complete clarity about them, so that when we are looking at P&L or balance sheet of a business, we are able to decipher what does it mean, and we are able to advise and guide our management with regard to the balance sheet and how to read the balance sheet.